DSCR is driven by cash flow, not sales. Timing matters, margins matter, cost structures matter. Revenue alone, it doesn't. When business owners get turned down for financing, the reaction is usually the same. Your revenue is strong, work is steady, the business feels viable, yet the answer is no. That disconnect almost always comes down to one metric, DSCR, debt service coverage ratio. Most owners hear the term without really understanding what it represents. It gets treated like another bank requirement, another hoop, another arbitrary rule. It's not. DSCR is how lenders answer a very specific question. Can this business service its debt without relying on optimism? That's it. Lenders aren't trying to predict how hard you'll work or how committed you are. They're trying to assess whether the existing cash engine can absorb another obligation without destabilization. DSCR measures that directly. At its simplest, DSCR compares cash available for debt service against required debt payments. If this business generates meaningfully more cash than it needs to cover its obligations, that ratio is healthy. If it doesn't, risk increases. Most lenders want to see a DSCR above 1, usually closer to 1.2, 1.3. That's all depending on the industry and the loan type. That buffer really matters. It represents a margin of error. The mistake owners make is assuming revenue growth automatically improves your DSCR. It doesn't. DSCR is driven by cash flow, not sales. Timing matters, margins matter, cost structures matter. Revenue alone, it doesn't. This is why businesses with impressive top-line numbers still fail the DSCR tests. Cash arrives late, expenses arrive early, debt payments arrive regardless. From the lender's perspective, that's risk. Another misunderstanding is thinking DSCR is purely backward-looking. It isn't. Lenders adjust it. They normalize owner compensation. They stress test the margins. They account for seasonality. They look for consistency, not peaks and valleys. A strong month doesn't just erase a weak quarter, or a good year doesn't override the volatility of the business. DSCR is a stability matrix. This is also why owners get frustrated when they believe they're being conservative. Maybe they take a lowest salary, they lean out the operations, and they minimize their distributions. Lenders often look at those numbers and look upwards. If the compensation isn't at market value, it gets normalized. If expenses look artificially low, well, they're corrected as well. The ratio gets recalculated based on what the business should look like to operate sustainably. That adjustment isn't punitive, it's protective. DSCR is designed to answer whether the business can support debt and still function normally. When owners fail a DSCR evaluation, the problem usually isn't the loan, it's the structure underneath. Margins may be too thin, fixed costs may be too high, debt may already be consuming too much cash, and receivables may be moving too slow. Adding more debt doesn't solve these issues, it actually amplifies them. This is where DSCR becomes useful beyond lending. A healthy DSCR means the business has breathing room. It can absorb surprises, it can invest without panic, and it can negotiate from strength. A weak DSCR means the business is already operating at the edge. One delayed payment or unexpected expense, it can cause instability. This is a signal. It's not the bank pinking on you because of your industry. It's the math and you aren't passing. Improving your DSCR doesn't require financial gymnastics. It requires structural changes. Pricing matters, controlling direct costs matters, controlling gross margin matters, labor productivity matters, budgeting and controlling your overhead matters, and improving receivable timing, that really matters. DSCR improves when cash flow improves relative to its obligations, not when revenue looks good. This is why some businesses get approved for financing easily while others struggle despite their similar size. One is built for margin of error and control in its model, the other hasn't. Lenders fund predictability, not potential. Owners who understand this stop chasing approval and start designing stability. Financing becomes a tool, not a gamble. The most important shift here is mindset. DSCR isn't a barrier imposed by banks, it's a mirror. It shows how resilient the business actually is. If the number is weak, that's useful information. It tells you where to focus before taking on any more risk. But if it's strong, you can use it as leverage. Either way, the feedback is definitely worth listening to. So before applying for your next loan, calculate your DSCR and be honest about it. Stress test it, remove optimism, normalize compensation, and assume reality. If the business can carry the debt and still breathe, financing can accelerate progress. If it can't, debt will only expose what's already fragile. That distinction matters more than approval itself. All right, guys, that's it for this week. Thanks for tuning in, and I'll see you next time. Until then, stay profitable.